Well, I think one thing we saw over the last year has been the real compression in spreads across credit exposure, and also the big issuance we're seeing on the government debt exposure, not just domestically, but also internationally. So we've seen opportunities across the government debt issuance space, both at the federal level, but also at a state level, in terms of being able to maximise and provide some return to investors above and beyond traditional periods, but also wanting to make sure that we maintain exposure to companies which have strong balance sheets and strong capital management positions, with, again, a good tailwind in the economy. So again, our exposure to the major Australian banks has been something which has been a positive for our portfolio. It's something which has held us in good stead over the COVID period and coming out of it. And we think that'll be something which will be a key part of our portfolio moving forward. So we're cautiously optimistic on the returns offered by senior and subordinated bank debt, not just Australian majors, but also non-majors locally. So a number of those indicators we use in terms of our assumptions and the models that we build to assess the returns, but also the impact should there be a drawdown on the returns for the fund. In terms of the economic indicators we look at, that will drive, I guess, where we look to allocate on a very high level between maybe credit or between government, and also undertaking then the relevant due diligence on the managers within those sectors that we may want to be exposed to, but also our existing exposure. So if there was a significant shift up in interest rates, or there was a significant shift in inflation expectations, how would each part of our portfolio be impacted, and to what degree, on a theoretical basis, according to our models, would that look like? So how would our return exposure shift? And what we can do to mitigate that, what we can do to prevent that as best as we can, is always front of mind through assessing and regularly reviewing those models and assumptions. Right now, I think one thing we see is the inflation expectations is building within the market, but one thing that people should be cognizant of in our eyes is that it's not just what the inflation expectations are, but what they're coming from. So we are at a historically low base in terms of inflation expectations. We're at a historically low base in terms of interest rates. So it won't just be where the inflation is going to get to, but how quickly. And also with interest rates, I know that there's been indications by the RBA that there'll be a number of years before we see interest rates starting to rise. But another question will be, well, if they do that sooner, how quickly will interest rates rise? Not just what will they get to. So that's something we're really conscious of, and we're in constant dialogue and making our own reevaluation and assessment at regular intervals as to what that may look like in the future. Well, within our Trilogy Monthly Income Trust, which is our flagship mortgage fund, we have a number of loans which we're exposed to across the Eastern Seaboard. We currently have over 90 loans within the portfolio. What we look to do there is diversify amongst the type of borrower we have, but also the industry and the state and the subsector they're exposed to. So it could be an industrial construction deal, for example, or it could be a completed residential stock deal. So we'll have different pricing metrics that we look at there. That pricing metric will then flow through to the return for investors. So we've been very strong in terms of being able to support those developers, and we look to provide a competitive return from that pricing that we offer those developers. That then is combined with the cash position within the fund at any one time, which we look to optimise via our exposure to our fixed income managers. So we're not sitting there with cash earning very little and then interest book at one point in time earning interest that's then combined. We're trying to blend a rate that's optimised via maximising returns on both the cash and the mortgage book at any one time. So we're actively moving at the moment more into more of a structured fixed interest and credit exposure is somewhere where we see opportunity still. We're still very much exposed to major and non-major Australian bank paper directly and indirectly, and we see new issuances coming up across the year where we could certainly generate some alpha there, but certainly looking to make sure that we are exposed to the subsectors within the fixed interest sector on our cash that we want to be exposed to at any point in time, given our return expectations we're looking for out of that portfolio.